Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
G'day, and welcome to episode 10 of Turtle Talk, the podcast where we explore outlier hunting with a healthy dose of turtle wisdom. I'm Rich, coming to you from Brisbane, and as always, I'm joined by my co-host from Tampa, Florida, the legendary Jerry Parker. Now, before we get into it, I should mention that Adam sends his apologies. He's out in the water with his sailing crew, practicing for the next Sydney to Hobart yacht race. So it's just Jerry and I holding down the fort today, along with a very special guest. Joining us from Arizona, alongside Jerry, is Cole Wilcox of Longboard Asset Management. Cole, welcome to Turtle Talk.
Thanks for having me.
It's a pleasure, and we're thrilled to have you here, Cole. So for those of you who don't know, Cole has been a significant voice in the trend following space for many years now, and we're really looking forward to picking his brain later on in the show. But here's what we've got in store for you today. First, I'll take you through the Battle of the Trend Indexes, which is a quick look at how the trend following indexes wrapped up in 2025. Then we'll dive into what's moved the needle. And this is where we have some live market action and charts from Jerry and myself, and from overnight's activity. It's going to be an interesting one. And we'll also get Cole's perspective from what he's seeing in relation to those charts as well. After that, we then have our spotlight segment. This is an extended conversation with Cole. So Jerry's going to lead us through the segment discussing Cole's journey, the philosophy, and his insights on systematic trading. And finally, we'll wrap up with some closing reflections. So without further ado, let's get into Battle of the Trends. So as many of our listeners know, each month we publish the Battle of the Trend Following Indexes report. And we've just wrapped up the December 2025 numbers. And for those who want to dive into the full report, you can find it at aussieturtles.com. We'll include the link in the show notes. Now, I'm going to keep this fairly brief because we've got a lot to cover today with Cole. But the big head outline for me is this. The classic trend following index in December has hit a new all-time high watermark. Now, Classic Trend Index now leads a pack of trend-following indices by a significant margin. So what's interesting to me is that while Classic has broken through to new highs, most of the other trend-following indexes still have ground to cover to reach their all-time peaks. That dispersion tells you something important about system design and the compounding advantage of classic trend-following approaches. But what I really want to highlight when viewing the VAMI chart, which I'll put on screen for everyone to view, is the enhanced convexity that classic trend demonstrates. In the current regime we're in, with genuine trends emerging across multiple asset classes, that convexity is being rewarded, and we're seeing classic trend diverge away from the other trend following pack. Classic Trend Index is designed to capture outsized moves, and when the environment is favourable, you see that come through in the numbers, which we're seeing right at this moment. So the regime right now appears to be very favourable for classic trend following. We're seeing genuine directional moves across commodities, currencies, and rates, and that's exactly the kind of environment where systematic trend followers thrive. So Jerry and Cole, I'll go to you first, Jerry. Have you got any comments about how the indices are performing at the moment?
Well, I think just to give Cole a brief update on all of this,
it's basically our classic trend following, which basically is versus everyone else. And what we're sort of saying is, here's what happens when you let profits run and don't resize the positions based upon volatility or correlation. And I think you may do that, Cole. You may adjust your trend following positions a bit based upon the correlations in the markets or the drawdown or the volatility. So classic, we don't do that. We just let it run the old turtle way. And so I think in this particular situation, though, we're starting off, and what's dominating performance is all of these open trades that no one's getting out of yet, except people are probably scaling back a bit. And so when the markets are great and keep going up, scaling out due to correlation and volatility is going to underperform. Then darn it, all of a sudden we get today where that scaling out probably looks pretty darn good. So unfortunately, we don't, we're probably going to, unless things turn around and settle down and go back up, this was quite a bad day for a strategy that doesn't reduce positions for any reason unless the trend changes compared to those who do, I guess.
Cole, your thoughts?
Yeah, I mean, it makes sense because I think in the beginning of the trend following industry 20 years ago, there was one definition of being a trend follower. There was not as much dispersion in the underlying strategies or positions or philosophy. But I think as the industry evolved, you definitely start to see people add more filters, more ideas, more multi-strat things, and a kind of a hard fork of the classic way that you're talking about, Jerry, and your philosophy versus kind of the rest of the industry. So it makes sense to bucket them into two different distinct kind of worlds and be able to measure one versus the other, because there are substantial differences between them, for better or worse.
All right, gents. So let's now move on to our next segment, which is What's Moved the Needle. So this is where we look at live market action and some charts that have caught our attention. Jerry, you've sent through some charts, and can you talk to us about what you're seeing in those charts?
Well, I love sitting over charts like this, and I do it pretty often. And the two I want to focus on. I'm mad at silver, so I can't talk about silver.
I'll talk about
this. Yeah, you sent silver over as well. So I don't want to talk about silver. I want to talk about, there was this one tweet I sent you this week, which was just amazing, that something like silver had a 4.5% annual return for 20 years. And it made it, and then now after 12 months, the annual return over the past 20 years is 10%. And I thought that was just exactly, that's trend following. Yeah. That's letting your profits run. And an underperformer or totally a non-performer like cocoa. I'm glad now that we have two markets we can talk about, cocoa and silver, or maybe cocoa, silver, and gold. But, we'll be talking about those for a long time, but you can have a non-performer like cocoa even do the same thing. Almost have an entire history of not making money, but really have an amazing trend. So the two charts I sent over were feeder cattle and live cattle, and I just wanted to highlight that sometimes when you're following these trends, you'll have some major sell-offs like we did in these two charts, silver. Feeder cattle and live cattle. And we had some today in silver and gold, platinum, palladium. I'm mad at all of those markets. And I think you jinxed us, Rich, for bringing, for that being all the charts you decided to show. So I'm going to be really, I flipped through the charts and you chose all the worst markets for today. But anyways, yeah, the lesson is, sometimes when you hang in there and suffer through some open trade profit drawdowns, the market goes back to the highs and keeps going. And the trends the trends may have a long way to go. And the whole point of that is, of course, that's true. Because if it wasn't true, the back test that we do would say, hey, don't trade these systems that are long term that sit through drawdowns like this. So not surprised, but I think it's worth mentioning.
Yeah, when I look at that feeder cattle chart, Jerry, I see it's gone from around 230 back in 2021 up to 365 today. That's a move of over 50% over roughly 4 years. But importantly, it's a trend you could ride the entire way if you had sufficiently loose pants, patience, and the process to do it. And I think that's going to be probably the moral of the story on today's session, after we talk about the metals overnight, is that this performance we're talking about is medium to long-term performance. It's not the performance over a week, 2 weeks, 3 weeks. This is something that particular process and our systems position into over the course of time. And when you look at these trends that emerge, typically you see that they emerge in periods of calm, when you get compression and you get all of the bad instincts arriving in the market, such as increased leverage because people aren't getting enough return in these periods of this apparent calm, this compression period. And basically the writing is set in the wall many, many years in advance of these volatility spikes and these significant exponential growing trends out of these periods of calm and compression. And that's why our particular process with breakouts and different methods, they're not looking at these moves over days or weeks. They're looking at these moves over years and how these complex adaptive systems evolve over time and how they fracture. And they certainly, you can't look at averages when you're looking at our particular process, because all of our performance is developed during extremes. It's the tail events that really matter for us. So when you look at feeder cattle and we look at, the underperformance of cocoa for so many years, that to us, that's indicative of the fact that, that when these things explode out of these periods of compression or whatever, they set new records, things that people have never seen before in their back test. It's inevitable that we get this. We're seeing it all the time these days, and we're getting these multi-sigma event moves, which, you've never recorded in history, but we're seeing it now in an environment that is chosen to be different to the environment we've had since post-World War II. This period of increasing globalization, etc., is now fractured. We're now going into a very fragmented world, and we're getting things that the backtest never told us happens if you're not looking at over, a significant sample size.
Every trend ultimately breaks, like whether it was a silver trade, today or others, they happen to have a lot of them break on the same day today because of the interlinkages of the news and the macro, kind of stuff. But it's not a new thing. Like those charts from the upswing to the downswing, I would argue that it's not a new outcome. It's just par for the course of what I've seen when trends work out and when trends break, and you're seeing them today, you're going to see them again in the future. The systematic part, or kind of going back to what you said before of like poor performance of cocoa, or you made all this money in silver, but it was kind of not a great performer for the previous, 20 years. I don't know how two things. I don't know how a discretionary investor handles a down 30% day, in silver, right? What do you do? What's your next move? How are you thinking about this? How are you managing this outlier of volatility? So that's one thing. What I have a strong bias towards systematic processes, because I just don't think a normal human can handle that. It's definitely an outlier day and just messes with what's next. And two, they also can't handle 20 years of mediocrity, false positives, trades that don't go anywhere. I mean, it's great that we have this macro environment that's caused silver to go nuts, but most of the time it's like walking paint dry, and the market isn't really doing anything, and you're just getting whipped in and out of something while there's some other stock or some other market creating FOMO that you could have been having a better trade in. So I just think it's the trend following, part of it. I just do not believe that it can be executed in a successful way on a discretionary, basis. I think that these markets are not easy. Sometimes they're easier. Like, okay, if you just started doing trend on silver this year, great, but you weren't around for all of this previous period of time.
Yeah, Jerry frequently talks about the fact that our process is hard and it flies against our brains, our intuition. And that's why we need this rules-based systematic process, because it's exactly in these moments of calamity where you tend to do the worst things possible. So as a trend follower, for instance, I notice that, I'll bring up silver, as Jerry's not going to talk about silver. I understand his grief, and I had grief as well with silver overnight. But I'll bring that chart up, and just to explain, it's gone parabolic in January, but the trend has been in force for multiple years now. So for those people that are just concerned with the parabolic move, that is the worst time to be making decisions. A systematic rules-based process would have you positioned well before it went parabolic. You'd be having signals that say, all right, there is a very good chance this is a material event emerging. Now is the time to get involved or position into your strategy. And then much later on, as the trend enforces itself, we get positive amplification from feedback mechanisms, etc. It starts going parabolic. That's the time where your rules and your positions have already been established, are in place. You know exactly what to do. And that's the time where, if you are only invested in this parabolic move, that is where you're going to make the biggest mistakes. And it's exactly where your system needs to override that. It needs to avoid being involved in these parabolic moves. And fortunately, our systems address this in how they engage in trend. But, I noticed overnight that there were calls on social media of this massive capitulation event. Now, for us trend followers that have been engaged in silver for multiple years now, all this is to us is a reduction in our unrealized profits that take us back a few weeks, back to, early January. We've already been a significant beneficiary with our trailing stop logic, etc., of a significant uprun in silver. And the same as the other metals as well, that all overnight came off substantially. I think palladium was hit fairly hard, copper, platinum, gold, they were all hit fairly hard with this unwinding event. And what I do notice is that when you see markets go parabolic like this, when you think of it in terms of complex adaptive systems, what that's telling you is the market is becoming exceedingly fragile, because there is no robustness to a market that is parabolic, because everyone's models are doing the same thing. They're all amplifying and going into that trend. They're scared to go against it. And once you get this lack of diversification in market structure, it becomes exceedingly fragile. So you only need some small event, particularly in a leveraged system, to cause this massive unwinding and the lift fall that we've experienced in these events. So I think to actually you need to be participating in these events, but you need your systems to have been involved in this participation well before those events actually arrive.
If you didn't know what happened and you weren't looking at these markets day to day, and all you did was look at the beginning of January to end of January, you would have no idea what happened. You think you had a great month in silver, gold, some of these other things, right? It's just that the one day give back is here. So a lot of this, volatility and concern about stuff is is just a function of how frequently are you looking at the statement. And so if, it's like the theory of knowledge kind of thing of if a tree falls in the wood and nobody's around to, hear it, did it make a sound, right? It's like, if you don't look at your statement, did it really matter to you if all you're seeing is the stock market every year has an average drawdown of 15%. I always tell people but if you only looked at your statement once a year, you wouldn't really, see that. So it's just how you handle the information that happens, how you react to it, whether or not it's noise. These markets like silver and trend reversals, this is just going to happen. And to your point, Jerry, about systems that react, if you can't handle a move like today, you're thinking, I have to have a profit-taking system to avoid this, or other kinds of things. I just have not found that strategies like that are robust over all market, cycles. You might get it right in one, situation, but the reality is that markets are going to find a way to break your kind of cute little filter or something. They're just not a very reliable approach that can handle every market thing thrown at you the way that classic trend strategies, kind of are. Like the alpha is in being able to just handle the moves and not have to be somebody who's constantly tinkering around with, adjusting your entries, your exits, or your money management to avoid random reversals or from time to time bad outlier movements like you have today in silver.
Yeah, that's good. Well said. I'm like you. I trade a lot of stocks, and I see this happen in stocks all the time. And 30% in a stock is like nothing. Right. Oh, yeah. Exactly. And then it's not cool for, no offense, Rich, but it's not cool for CTAs to even talk about 30% because we don't use percent. We use ATRs. And it was, today's ATR wasn't, it was a nice move, but it wasn't like a crazy move. It wasn't extreme. So, these markets, if you look at the markets in terms of percentages, you get all kinds of wrong-headed ideas. Or if you're trading using percentages, that's not going to work out as well as using the ATR approach, which totally ignores percentage. Another thing that's really helpful, sometimes, not all the time, but sometimes what's really helpful is trading a lot of markets. So the more markets you trade today, the better. Especially if you equal weight all the markets. So I have one fund that trades 400 markets and all the positions are equal weighted. So, I didn't get to have a great January due to silver and gold because it just wouldn't move the needle enough. And thus I don't get crushed when it has an extremely bad day. But that doesn't always work because sometimes it won't just be silver and gold. And sometimes half of those 400 markets are stocks. So sometimes all the stocks will go down.
What's impressing me about these events is that what we're seeing plus 6 sigma event moves in either direction on these metals, which is, from a Gaussian perspective is almost unheard of. And this is occurring with frightening regularity these days. So it just further debunks the efficient markets hypothesis, further debunks the fact that averages are important. We know that it's actually the tails that drive performance over the long term. It either drives your demise or it drives your opportunity. And I think these events really highlight it and bring it to people's attention if they can remember it, because people will forget about these events over the last month, etc. They're going to forget about that in about a couple of years, etc. But it's important to remember them. All right, so I've got a few more charts. They show a similar story to silver. I've got, of course, the gold futures, but let's put this into context. So even after last night's reversal, gold is still sitting at $4,800 US per ton. Let that sink in for a moment, because gold has doubled from where it was trading back in late 2022, where it was around 2,400 US per ton. So the key point here is that we've been positioned in gold for years. This isn't about capturing the January spike. We entered the trend back when gold was consolidating, and we've ridden the entire way up. If we look at platinum, that's another historic sign. We had a big downturn, of course, overnight, but it's gone up from 1,050 in late 2024 to 3,000 in just over a year. That's a near tripling of price. So this is a market that many people had written off. It was languishing while gold and silver got all the attention. But because we spread our nets wide with maximum diversification, we were addressing the entire metals complex. And we were there with our models when platinum woke up. That's the power of diversification. You don't need to pick which metal is going to move. You just need to be positioned across all of them and let the trends reveal themselves. So when we look at all of these things together, this is what I want to spell out. We've been positioned for these metals markets in particular well in advance. We've entered these trends over the last few years. It's not about capturing the January spike. It's about being in position when the move accelerates. You've probably heard the recent commotion in the financial media about this extreme volatility in gold and silver, the nervousness, the dramatic headlines, the prediction about what comes next. And this reinforces something fundamental about trend following. When trends heat up, there's always an overwhelming narrative of emotion-driven responses. Fear of missing out, fear of giving back profits, analysts calling tops and bottoms. But here's the thing. Those of us who simply apply our rules consistently, who have loose pants and let the systems do their work, we avoid this commotion entirely. We don't have to make those difficult emotional decisions. The system handles it well in advance of the narratives and emotions ever developing. That's the beauty of systematic trading. The noise becomes irrelevant when you trust your process.
Cole and I have been friends for a long time, and we've hung out together a bit, and you were in Tampa not too long ago. And I've watched you a lot, obviously I've tried to watch all your podcasts, and I watched a couple recently. I liked them. They were really good. But give us a overview of your current strategy. And I know you have a mutual fund, and it's trend following stocks, but give us an overview of where you are now.
Yeah, I mean, I would definitely put it into your definition, Jerry, of a classic trend following from a philosophy, kind of standpoint. So, I mean, I've run systematic multi-asset trend strategies, but today we exclusively focus on systematic trend on every security in the U.S. stock market. So our universe of coverage that we're looking and identifying trends from is the Russell 3000. So it's the 3,000 largest U.S.-based companies. And last year, we published an update to our paper because does trend following work on stocks. And one of the things that you talked about earlier was, this power law or minority of trades dominating all of the, kind of results. And what we've seen is, in two areas, whether you're talking about stock market indexes. There's this great paper that we contributed to with Hendrik Bessenbinder for the, it's called Do Stocks Outperform Treasury Bills? And it was a study to kind of look at the distribution of where did the performance come from stock market indexes over time. And really what you found is that all of the returns of the entire US stock market have come from 5% of companies that were ever part of the US market and from these indexes. They just were basically these monster trends that went on to just continue to compound and grow and generated all the returns. And if you could own the other 95% of stocks and you ended up making returns that were no better than treasury bills. So capturing those outliers and this philosophy of trend following is just as mathematically relevant and important to a stock market index fund as it is to a systematic, trend follower from a distribution of the results. What we did in our, kind of research was say, could we marry kind of the two together? Is there a way that we could take our background in trend following and create a better equity market mousetrap, right? So where we could get the results of these great outliers that exist inside of indexes over time, but where we could reduce the the downside risk associated with it. If you invest in an equity market index, you have a depression, it could go down 80%, right? Unlikely, but possible. Routinely, you're going to have 50 to plus % drawdowns at a general market, kind of level. That I would say that kind of path traveled of investing is just not acceptable to a lot of investors, right? I mean, everybody would probably put all their money into the stock market, given the returns that it's had, if they could handle the volatility, but they can't. And so we're like, could we marry this philosophy and mechanisms that we understood about trend following, but to this other universe of individual stocks where we can capture these outliers, have less of that 95% mediocrity to losers, and just create a better risk-adjusted return where we can have the same equity-like results, but not anywhere near the kind of risk that you get from an index fund. And that's what we do, like in our strategy and in our kind of approach. So the fusion of the benefits that people love and the compounding benefits of investing in equities with the risk management discipline of trend following that typically has been applied to a multi-asset kind of long-short portfolio.
You say in some of your podcasts, I've heard you say single stocks have a higher signal to noise ratio than indices. Explain what you mean by that. And here's a big question. Don't shy away from my tough questions, Cole.
I like tough questions.
That's right. Why don't, in your opinion, why don't CTAs, managed futures, use single stocks instead of indices in their trend following portfolios? I think some of them, my snooping around is that I think some of them will say that they monitor 5,000 stocks, but these 5,000 stocks or the stock program or whatever, it doesn't quite make it into the trend following portfolio where the indices are sacrosanct. Why do you think that is?
Honestly, I've been asking that question since we first published the original paper in 2005, and given the popularity and how many people have read it, that you don't see them kind of doing it. Must chalk it up to either a combination of like it's futures and they need the leverage, which they're not getting, from equities, or just straight up like, I don't know, laziness, inconvenience. Because the reality is, if anybody looks at the data, it's very, very clear that there is an alpha advantage to doing trend following on individual securities relative to trend on stock indexes. And I mean, a child could understand this, that if you have an index that has 500 stocks inside of it, and you're going to take a trend signal off of it, well, the index itself is comprised of 500 companies that each individually have their own market trends and are kind of like cross currents fighting one another. And then you're going to like take a signal off of that. Whereas if you would just simply deconstruct the index and look at the individual trends of each one, you would be long the pure trends that were working, and you would be either flat or short the ones that were not working with inside of the index. I mean, the S&P 500 could be making new all-time highs and you're long with inside of the index, but I can tell you that there are companies that you would not be long from that same trend following strategy at that same time. So that's one, kind of, part of it. I also will tell you that trading in investing in equities in this way is vastly superiorly tax efficient to do cash equity investing over futures for US based investors, because you can defer capital gains as long as you want in a long-term trend following thing. You can tax loss harvest and build up capital losses against your future gains that you're going to take from your winners, relative to you have to mark to market your portfolio every year and pay taxes, and whether or not you had realized gains or not. The 1256 treatment requires you to market for everything with a combination of realized and unrealized gains, even though that might turn into a losing trade for you, kind of in the future. That doesn't happen with, cash equities. And then the third thing is the outlier dispersion, right? You individual companies, some of them will go on to have these massive compounding trends, and then other ones will go bankrupt and fail. And so the dispersion that you're looking for, that outlier movement that you need in order to be profitable as a trend follower, to add alpha or add value, is all there for the taking when you're talking about looking at the individual kind of bottom-up security trend stuff. And since you're in a trend portfolio, if you take it, you're taking that equity market beta risk or the trend risk or the ATR multiple risk, like whatever risk units you're putting into that equity index, you're taking that systematic risk of that trade. If you just did it on individual stocks with a proportional amount, there's no risk difference between the two. You just have a different allocation of portfolio to pure trending stocks that are driving the performance of the market, and then eliminating the stuff that is not trending or is negative. And this adds up to a substantial amount of value add, over time, relative to just taking signals, entry exit signals on aggregate equity indexes.
It seems also that the correlation amongst the indices is fairly high compared to the correlation of the individual stocks. They can be, we analyze 1,000 stocks a day, and I would say right now, from a trend following point of view, 30% are in a downtrend, and some are flat, but probably all the indices are probably pretty much in an uptrend. And then you have this flexibility with the portfolio too. You can design the portfolio of stocks to get massive diversification that you won't get from the Magnificent Seven.
Well, you won't get that the reason that all of these markets, even global international markets, are more correlated than they were before is because every index that a futures contract is tied to is going to be a capitalization weighted index mechanism, right? So in and of itself, it's like a very brute force trend following system. It just is like letting winners ride and not doing any rebalancing, kind of to it over time. And the United States has become a more and more and more, because of the capitalization bias of mega cap companies, has become more dominant in all of these indexes. If you use the IFA, kind of international stuff, there's still a heavy U.S. equity allocation inside of that in a globally diversified portfolio, and it's much larger than it used to be in the past because of the capitalization dominance of mega cap, multi-trillion-dollar caps. So when you do individual securities, you can eliminate that market cap bias that exists in every single futures contract. Every equity market that has a futures contract tied to it that you're going to trade is a large cap biased thing with a heavy US weight, inside of it. Even like you say, the Russell 3000, you think that's 3,000 companies, but it's cap weighted. It looks no different than the S&P 500. They're identical risk distribution between the two. Now, to get an equal weight version of that, there's no futures contract for it. You can replicate it by breaking up trading trends on each individual one, and then change the profile and actually have like in our strategy, our smallest cap position could have just as much profit impact on the future profits as, Microsoft, right, could, today. Whereas that's not the case when you do trend following on stock market indexes that are cap based. You're basically saying, I'm betting all of my money on 50 stocks and the trends associated with that. These other companies that may have mega outliers, they just have no representation inside of that index. The only way that you could get them to have equal representation is to trade the individual securities.
And there's no evidence from our research, and I'm sure from yours, that the larger stocks are superior trending markets.
They're not superior trending market. The only evidence that exists between large cap stocks and small cap stocks is that historically the large cap it has less volatility, right? There is less variance in large cap stocks than there are in small cap stocks, as an example. But that doesn't mean anything from the context of trend, this has more volatility, because to us, volatility is not risk. What you need is larger skew, bigger outliers that happen. And you absolutely see these massive moves come from the small, or at least originate from the small and mid cap, kind of world. Like, okay, Nvidia has had this huge move. Well, today it's a massive company. Well, while it was making all those percentage gains, it wasn't a massive company. It started as a small cap company. It moved to a mid cap company. Then it moved to a smallish, on the smaller side of the large caps. And then in the last few years, it's moved into on the largest side of the large caps. When I first bought Tesla in 2013, it was a $2 billion market cap. And firmly in the small cap categorization, it's now 1.5 trillion or something along the way. So if you're only looking at large cap companies, or you're doing trend on large cap companies, you're actually not doing trend on the next Tesla or the next Nvidia or the next whatever, because they do not move the needle. They have no representation in those indexes that you're doing trend on.
That's a great point. It's so frustrating too, because one of our friends, maybe it's just Rich's friend, put out a paper recently that he was comparing the currencies, the commodities, the bonds, and the stocks, and trend following those four sectors. I don't remember the paper. I just remember one of the conclusions was stocks are a lot worse than the other markets. And yeah, because you're using indices. Use the dollar index to replace the currencies, or use the commodity index to replace the commodities, something that no one would ever do. It makes no sense to do that. Likewise, it makes no sense to trade these indices. Okay, in the interest of time, let me keep going here. So in your podcast, you make the point I agree with, and you make it a lot, that diversified trend following is very frustrating, and especially recently, of course, but it's frustrating for many different reasons. Client expectations, clients FOMO, client comparing it to the stocks, all of which I understand and I agree with. But at one point, you sort of said something that I didn't really agree with, and that is...
That's not the first time, Jerry, that we...
No. True. But it won't be the last. Just making a wild prediction here. I will predict that, even though I don't like to predict in the markets, I will predict that. You said something like, stocks have an infinitely higher compounded annual growth rate than diversified trend following. So my question is...
Okay, well, if I said that, even I disagree with that. Infinite,
okay, good.
A little bit ridiculous.
I know. I can't imagine you being able to...
There you go.
I couldn't imagine you being able to defend that. But anyways, I do think that you do believe that that almost like stock trend following, or stocks in general, choose whichever one you want, is inherently superior to trend following a diverse asset group like CTAs do and managed futures people do. And so my question is, do you really believe that forever that trend following cannot diversify trend following in a typical CTA portfolio, if you call it multi-asset, will it have no chance of catching up over the long run and getting back to maybe when I started in the business in the 90s, where it not only made more money, not only did it have more diversification, lower drawdowns, it actually made more money than stocks? Or do you see some sort of inherent characteristic of stocks and stock trends that it's destined over time to just continue not always, but over time, outperforming diversified trend following?
Well, when you say performing, are we just talking about the compounded annual growth rate, nothing else?
Yes.
Okay. Well, I would say that it's not really a fair comparison necessarily between the two, because when I'm doing trend following on individual stocks, I'm really benefiting from the outcome of American capitalism, so specifically U.S. equities, right? So we have this machine that we're in, that America is going to compete. We're going to create companies you're going to collect, that's going to lead to these huge future winners, right? You're making a bet that American capitalism is going to produce great businesses, solve problems, there's going to be a return on equity, great businesses are going to be built, and wealth will get created from doing that. And you're attaching your kind of cart to that horse. And that is a big kind of, I would say, just tailwind behind trend on stocks. It isn't inherently a bet. Now, it also acknowledges that American capitalism can be volatile, right? That you can go through depressions, you can go through other periods, and you have to be able to preserve capital in order to not interrupt your compounding. If you do get a sequence of events, it's very difficult or very volatile for the economy as a whole. But you're always very bullish on the American capitalism system of producing great businesses and earning and growing. If we were to have an environment where the history of America competing and succeeding and capitalism winning was not the case, then I would be like, well, and the stock market is terrible and we have anti-capitalism, and well, then I don't agree. Then I'm like, well, I don't think that's going to work very well. So I'm just saying there's an inherent bias that exists in the trend on stocks. You are making a bet on the system, but you're just navigating it differently than betting on an index, as an example, because I have to acknowledge there can be a 80% decline in the stock market, and that's not acceptable, to me from a wealth management standpoint. You need diversity against that outcome.
But you've seen stats, you've seen the stats over time in the history of how long the stock market can go, and has gone with negative returns. And so are you basically saying that you think that period is kind of over?
Well, no, but those studies are in terms of the negative returns thing. They're very sequence of returns dependent. So yes, if you start at the very top of the market and the lost decade, let's say the most recent one from 2000 to 2010 or whatever, you start in the very peak of 2000 and walk it forward. Yeah, there was a lost decade, it didn't make any progress. But if you start it in 2002, the period of time from 2002 till 2010 was not a lost 8-year period. So it's very start and stop date dependent. Yeah, yes, there are certain people that if that's your window of time, that was the result. But it misrepresents the duration. Like, yes, that vintage of 1 year didn't work for 20, but it wasn't as bad when you went forward in time. So I'm not saying that we're in a period where you're not going to have massive declines in the market and drawdowns and risk associated with being an equity investor. The long only just index, I acknowledge that there is, which is why there's a need for trend following risk management strategies. What I'm saying when I talk about the compounding results is like, these trends are not divorced from the economic reality of stuff, right? I made a lot of money in Tesla because it went from a company that was, had limited and no revenue, to something that, has, obscene amount of $100 billion of revenue or whatever. And their equity value went up during that period of time. It led behind a stock trend. When we're doing trend on multi-asset, right? The difference for me about that is it's harder for me to say, why do I deserve to make money? Like, what is the risk premium here? Like, why am I going to make money? What's the mechanics behind why the market should transfer high compounded annual growth rates to me? Simply because I'm going long or short cocoa, sugar, commodities. I can tell you, yes, I understand that if fiat currency blows up, trend following is going to make money and gold will go up and these other kinds of events. I just don't have the same economic rationale. And this is really like just a comfort factor. Like, I like the understanding that I can go down to first principles and tell you, I understand why stock trends get created. And I understand and have a high conviction level as to why they are sustainable forever. Because it is a natural byproduct and output of American capitalism and entrepreneur that you will have winners and losers. Companies will get formed. Successes will happen. Failures will happen. Trend following is a great way to navigate through all of that, right? Like, it would be a great venture capital investor if it could allocate capital if venture markets were like liquid. You'd be going along SpaceX and other kinds of things along the way earlier on in the cycle. I just don't personally understand why I should be expected to make a 8 to 10% compounded growth rate from just trending markets of all of this other stuff. I'm not saying it can't happen or that you shouldn't even have allocations, to those things because there's other non-correlated benefits. I just look at it and say, I believe in the system of equities and American capitalism. And I think if you just isolate one thing about it is I don't like the volatility of it. And how do you manage the downside risk? Most people are buying trend managed future strategies to manage equity risk. And I'm like, well, what if we just applied trend directly to the equities in order to manage the downside risk, in order to manage the drawdowns that you're trying to reduce by going to this whole other alternative asset class? That's the philosophical difference, kind of.
That's why we love you, Cole. 100% trend following on stocks. Yep.
I couldn't agree with you more. I mean, in my opinion, every market needs a trailing stop and a stop loss. And if you want to add crisis alpha to portfolios, apply some trend following to your stocks. I think that would go a long way. And we do that, at our firm, we trade a lot of stocks in trend following, and we trade no indices. I'll run out of time to just keep going with this particular topic, but we'll get back to it at a later date. But I want to ask one more question, a slightly different question, and I've heard you talk about this too. I don't have a fund that is 50% managed futures and 50% S&P. I missed out on that. And I don't really warm up to that idea so much, or the stacking. I'm jealous. I wish I had one. It was a mistake not to have one, but now it's too late, right? So I'm doing the stock trading. One of our funds is 50% stocks. The other is 25% stocks, and it's trend following. And so that's the best I can do. And of course, that is not outperforming 50% S&P, 50% managed futures, or 100% S&P and 100% managed futures. What do you think about those products?
I think that they solve a use case in the market. Like, I'm not an investor in those products personally because I find them to be very expensive ways of getting what I could otherwise get on my own. If I wanted that allocation, I would buy a zero fee index fund, and then I would buy my trend following manager basket of choice, and that combined cost structure between those two things should probably be like 50 basis points. Whereas those combined products are, 1.5, 1.28, there's different fee structures for it. So also, I don't find them to be compelling value propositions for me personally if I wanted that allocation, but I don't have the problem that they are a solution towards. They're designed to eliminate investor statement risk, so an investor can't really handle emotionally getting behind the performance of a 60-40 portfolio. So they're kind of a hedge by putting 50% into the equities. You're always going to get that up capture there, which is going to keep you kind of in line with that 60-40 benchmark. And then you've got a different kind of diversification in it that's unique and with the correlation pair of the trend. And it looks nice on a statement in one wrapper. So nobody, kind of the end investor, doesn't see the component parts. Because if they observe the component parts, then they got to see volatility and movement that they don't really like. And then that would change their behavior to either two problems: have FOMO when the managed futures part isn't working and they just hate the poor performance of it when it's going through a weak period, or give up on the S&P part when it's going through a large drawdown. So they're a blending of the two. It's just kind of like an alternative to the 60-40 portfolio. They just threw out fixed income as the diversifier, and are using managed futures and the low correlation kind of between the two. So I think they have their place. I talk with investors in those products, and I understand why, they're there. I wouldn't want to be a fund manager, kind of doing that, just in the sense that I think the component principal parts of it are very cheap to get access to, and you're going to just continue to have fee compression at some point. those two things put together in a single product is going to be like indexed away. So I don't know, maybe you missed the beginning of the phase of stuff of, the wave of early adopter kind of thing, but I don't think that that's a sustainable product over the next 10 years if you're trying to charge, fees for it. I think it's going to get commoditized because it's not really a thing.
Yeah. One of the things I dislike is this line item risk argument that let's hide this. Clients can't handle managed futures, so let's make it a combination because of line item risk. It's like these clients are weak, they're dumb, we have to talk down to them. Maybe the RIAs are the ones who are saying, yeah, they are weak, they are dumb, we do need to talk down to them. But once again, they're really popular, so I'm in the vast minority here.
It's not talking down to them. They just recognize that they're human beings and the clients are who they are. So it's like, how do I get you to do the right thing or do the right thing for you as an advisor, but in a way that you can kind of, handle, right? So it's like, well, let's, wrap the medicine in some peanut butter and then my dog will take it. You could argue that I should just educate the dog on why the medicine is good for you, but it is easier to just put it in peanut butter and give it to them and everybody's happy. And sometimes, that is the better way of doing stuff. But so they're not dumb. No, none of the clients are dumb. The advisors are not dumb. It's just a different need about emotions, and they don't know what they don't know. And it is a better delivery mechanism for the average person, because otherwise they would just get in at the wrong time, get out at the wrong time, and it would just be a disaster for everybody. So,
yeah, no, I just think it sounds like they're talking down to people. That's all. But I think if I had to debate Eric on this in a conference room, and I think people in the audience would agree with me, and they would go right out and buy Eric's fund because they know what they. When you go, I would appeal to challenging people and appeal to their manhood and say, "Come on, you can do it. Buy some S&P, buy some managed futures. Don't be wimpy." And they would nod their head yes, and then not do it.
Well, they would probably think you were talking down to them if you put
exactly. That's right. I am talking down to them. You're right. Okay, Rich, take over. Sorry for dominating.
No, that's fine, Jerry. And look, it's been a fascinating conversation. So, look, so I understand it, Cole. You're long only in the Russell, the individual constituents of the Russell, and in times of bear markets, you'll flip to T-bills.
I don't like to use the word long only because we get confused. We think we're just long. I think of a long only manager as an index fund. You're just always long. We are long stock market, individual security trends of the top performing companies, and then we are not invested in any of which is the majority of the market, companies that are in negative or poor performing trends. So we own the best trends in the market. In a world where there are no top performing trends or trends in general, because it's just a massive, terrible market, we will rotate the portfolio. We'll hold exclusively treasury bills and be completely risk off in the rare instances that you have a major macro market kind of blow up like that, which is once a decade or whatever.
Okay, and it's all absolute momentum. You're not into this cross-sectional momentum, rotating just into the top performing stocks all the time.
No, it's classic long-term trend following, even longer term than you guys are doing, or the longest term futures person. We want to hold on to trending stocks for years, not months, days, quarters. We do not like selling or getting out of positions. I put us more into the investor time frame than it is the trader time frame when it comes to the positions that we hold on to and we make money with. The trader time frame is more about just the ones where we're folding our losses, right? We lose money on 56% of the trades that we do. We're kind of quick to cut the losses and move on, but very slow to get out of these long duration mega trends that play out for years.
And you do use stops?
Yes, every single position in the portfolio is entry, exit, stop, risk allocation. This is a 100% rules-based, systematic, classic trend. It looks no different than anybody in the CTA world. We're just trading a different universe.
All right, so we've got to have a competition here to see who's got the loosest pants. It's either Cole or Jerry. I've got a feeling Cole might have looser pants than you, Jerry.
He might.
Well, not on an ATR basis, as you pointed out, in these things, but as a percent away from your average position in your market, because we trade more volatile markets, right? These stocks have way larger dispersion than your average position that is inside of a diversified, kind of portfolio. There's lower vol in currencies and fixed income and equity indexes than there is in individual securities.
What I love, Cole, is you set yourself apart from the balance of trend followers. You've obviously got a unique proposition here. You've got a unique return stream. So I'd encourage everyone to have a look at the performance of Longboard and see how it fits within their traditional portfolios or whatever. But I could imagine, Cole, that would be a significant reason why you haven't forayed into futures and you keep to your...
Yeah, I mean, it's about being, different. I mean, if you look and benchmark us, our performance total return, right, is top of the list in terms of compounded annual growth rate relative to the SG Trend Index or other trend strategies. We have top decile performance, but we also have almost zero correlation to those managers, in that space. So we're both an excellent standalone investment to just be less risky equity kind of exposure, but we're also a great complement to diversified trend, exposure. We get a different source of return. We're not risk stacking. If you hire two different multi-asset managers, they're going to be very correlated to each other and move at the same time. So there's not as much diversity than if you paired us with a like Jerry and us together. We're going to do something very different. Great independent of each other and going to get good results, but really good correlation properties because we're going to be uncorrelated strategies to one another.
All right, everyone. I think we'll wrap up this spotlight section. Anything else you want to ask, Jerry?
No, I mean, we have to get Cole back. Lots more to talk about.
I think so, because he's got off quite easily. We haven't talked about shorts. We haven't talked about shorts and why isn't trading commodities. So that's for the next one.
Well, those are different, interesting topics about why we don't short individual, securities and things. It's not that there isn't an opportunity there, or there's a structural reasons, some other stuff, but there was a whole other host of, trading, and the differences in individual company trends and market structure stuff with equities versus index products. Happy to chat about it.
Perfect. Right, everyone. Well, thank you very much. And Cole, it's been wonderful having you on board, and thank you very much. Before we go, I'd just like to talk about this new release of a book I've just produced called The Fractals of Finance. It goes in the tradition of Benoit Mandelbrot and sort of goes further into the reasons for why we adopt trend following. I think some of you might get something out of it. Jerry's done a magnificent forward for it. So, Jerry, thank you very much for that. It was a really great forward, and I think just the forward alone is enough reason to get that book. But look, for next month, we've got an interesting one lined up. We've got Sanjeev Lakampal coming in, talking to us about Horizon 3. That's going to be great having him on board, and also we'll be doing a feature segment of the Fractals of Finance. But gentlemen, it's been fantastic. Cole, if people want to contact you, how do they get you?
3 places. The website, which is longboardfunds.com, or, direct where I'm more prevalent is on LinkedIn, so my name at LinkedIn, or my name, Cole Wilcox, CIO, at Cole Wilcox, CIO on X, formerly Twitter. Those are the 3 places that we're active. I'm pretty active on LinkedIn and X. Perfect.
Well, thank you very much for that. Look, so just in a wrap up, I think we're seeing markets do things we've never seen in the backtests at the moment. We're in a new regime. Expect the unexpected. Apply the process with rigor. Don't let those emotions get involved. Be systematic and endure and stay with the trends. So I think we'll wrap up, but thank you, everyone, for attending. It's been great having you on board. And as always, stay systematic, stay patient, and may the trend be with you all. Bye-bye.
Thanks, Rich. Thanks, Cole.
Thank you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.